Welcome to the weekly video update where I'll go over the action in the market for the week of February 3rd through the 7th, and we'll see how things look for the week of February 10th through the 14th. Okay, had another little down week. Things were looking like they were improving. We gapped lower on Monday and then clawed our way back to set the weekly high right at the close on Thursday. Well, then we hit overhead resistance at 6,100 and we started to go down. We ended up being negative on the week. Had we closed on Thursday, we would have been positive on the week. Now, some folks are blaming the consumer sentiment report that came out, and yeah, it's more pessimistic. Not only how people are feeling right now, but how they're feeling looking out into the future. Yeah, I mean, there's something to be said for that. But just about the time that report came out, we hit 6,100 at resistance, and that's been resistance before. And to see those two kind of converge with each other, it's one of those, okay, is it the chicken or the egg? Is the market taking advantage of the news, or is the news driving the market? There are times when the market actually does something before we see it breaking in news. There's, of course, other times when something happens in the news and then it's impacted in the market. Now, we are still positive on the daily side because we're above the 20, 50, and 200-day moving averages. We're still positive here on the weekly side. But when you look at the short-term trending chart, the ADX that I use, that's not trending. The intermediate term is not trending. Here on the weekly chart, we're not trending. So that's why you're seeing this kind of meandering, going up, going down, not really having a lot of real conviction behind it. But the smart money is coming in there and buying. Their growth to value ratios are holding up. Volume is still pretty heavy. We actually dropped off a little bit in Friday's session, which is surprising because the most important economic report of the whole month is the employment situation report. And that had kind of a muted response and it was weaker than expected. But when they came out and revised the previous month's numbers, they revised them up. So the market's a little confused right now. And then you've got the new administration with all these executive orders and tariffs, and we're going to take Gaza and, all that stuff. And you've got a lot of folks that are kind of confused right now, including the stock market. And so it's just kind of meandering around for the time. All right. Before I get into the video, I do videos every day, and they're available on YouTube and Rumble. You're welcome to check those out. Now, one thing that I locked these down a little bit about a few months ago, where you have to belong to my website to get immediate access to the videos. I delay them going public on YouTube and Rumble. For at least a little while longer, my website is free. But if you want to get access to that, feel free to check that out. I do have a program. There's courses that I'm waiting to roll out. There's additional videos that I do there. In fact, another thing that I'm rolling out is a thing called the daily and weekly newsletter, where if you don't have time to watch the weekly video, you don't have time to watch the video every day. It's free for right now. So go check that out. It's available on the website and it's also available in the Facebook group if you want to go ahead and join that. And I'll talk about that here in just a second. But I'm going to be locking those down at some point. There'll be fees that will be charged for these things, but while I'm trying to work everything out logistically and so forth, they're out there. And if you have any feedback, that I've been an educator for a long time, and a lot of the ideas that I've implemented over the years originated from people that I was trying to help or I was trying to educate or instruct. So if you have any ideas, let me know what you think of that. But check it out, see what you think about that. Also, I put a PDF of below each video that I post. And there are some folks who find that beneficial to download that, and you can see the charts a little bit better. You have the notes that you see right here. Also, this is the program that I have. It's called the SPX Investing Program. I focus on the S&P 500. I think that's the best tool and vehicle that there is for all kinds of different strategies when we're going up, down, sideways. You can generate income, you can generate capital gains. It's very liquid. You can get in and out of positions really quickly. And so that's why I settled on this decades ago. And that's why I have the name, the SPX Investing Program. Here is a link. And there's also a link right below this video that will take you to the website. That's where you'll find the newsletter. That's where you'll get access to the daily and weekly videos as soon as they're available. Then every day on the YouTube community tab, I update pivot points. There's a chart that the pivot points last for the whole month, but I update the chart every day with the new bar for that day. And then there's other pivot points that only apply to that particular day. So there's two charts there that you're welcome to check out. Also, I do have a private Facebook group. Now, I've been posting about the daily newsletter and weekly newsletter in the Facebook group. If you don't belong to Facebook, that wouldn't apply to you. But if you do and you want to join the group, send me a message there and I'll be glad to let you into the group. It's not an active group. I'm the only one that really posts there now. I post whenever a video is made public, and now I've been posting the daily and weekly newsletter, a link to the PDF. If you want to change that, it's a way that we can have some back and forth with each other. All right, and then I really guard YouTube and Rumble comments closely. I get a lot of crap comments, especially on Rumble. These social media experts that come in and say that they're really scams, is what they are. And I include an email address in my videos, and they tell me how great the videos are. Well, they obviously didn't watch them because I give an email address. And I haven't had anybody contact me by email. So I just delete those comments. And if there's something that is completely irrelevant, it's put up there by a bot or it's just gobbledygook that doesn't make any sense. Yeah, I delete those. But for the most part, you are welcome to leave a comment and we can have some back and forth that way as well. Now, if you do go to the website, you have more direct access with me that way. But I guard the comments pretty closely. I don't want the garbage stuff up there. And I don't get a lot of comments because I take my approach to educating and sharing information. I'm not telling you what you need to do. I'm not telling you what you need to think or what conclusions you need to reach. I'm trying to present information to you, and then you decide what to do with that. That's what a real educator does. It's not indoctrination. It's informing people in developing this idea of critical thinking. And that's really where I come from. Anyway, I do post both on YouTube and Rumble, and that might be a backup. And if you like one platform over the other, you can find me on both places. Okay, so for the week, we were down 0.24%. As I said, if we'd closed on Thursday, we would have been up. We ended up having a down day on Friday. We were above average with volume, and we are still looking positive. We're not trending now. We're kind of chopping sideways on all the different time frames. And if you're a momentum type investor or trader, that can be kind of frustrating. Now, there are types of strategies that you can implement that really benefit from a sideways market. I'm not really covering those as much right now in the program, but they are available. And if you want to discuss those things, go over to the website. We can set up a time to talk either on YouTube or not YouTube, on Zoom or Skype or Messenger, whatever platform you use there. But as far as looking at the overall picture, we're still positive for right now. We have been seeing our smart money indicators, and I'll show you the weekly versions of those here in just a moment. The smart money is coming in and doing some buying, but they can sit back and wait. They're not under a lot of the time constraints that we are. And that's what was really helping things improve throughout the week. And it hasn't totally turned that negative after Friday's session, but we might be in for some sideways action for a while. But we could break out of that. And what I found over the years of doing this is the longer we chop sideways, the more momentum the up move or down move will ultimately have. But we're coming down a bit now with interest rates. We're getting some more concerns about inflation. In fact, just on Friday with the employment situation report, people are working less each week, but they're making more. So that didn't sit too well with the market. And that's kind of the real watch right now is we're seeing commodities going up with all these tariffs and different changes and executive orders and all the things that are going on. What's that going to do? And well, it's happening so fast that folks are having a really hard time keeping up with all of that. And that kind of fits into the geopolitical arena. It could be the domestic arena because that's applying more mostly to the US, but then that bleeds over into the international sphere as well. We're in the middle of earnings season right now, and so that can have an impact too. It's usually on a stock by stock basis, but you get a big stock that's really influential. They come out with their earnings, and that can drive the whole market. It There's still this debate going on back and forth of are we going to go into a recession? Are we not? We're just waiting as the data is released, not trying to project anything, just trying to say, okay, this is what the evidence is that we're seeing right now, and you can make a case for either side at this point. But these are things that I keep a really close eye on, and then I do periodic supplemental videos that are only available on the website. And then not really much in the way of Fed speak, but on Monday, Chairperson Powell is going to be speaking, and that can drive the markets. So be aware of that happening on Monday. As far as our trend, we're still not trending. As I said, in the short and intermediate term on the daily side, we're not trending. Here on the weekly side, we're not trending, but we are still positive. Okay, and if you don't know what that means, I'll get to that chart here in just a moment. Here's some bullet points as to what happened. The S&P 500 was chopping back higher after hitting Monday's low. For the last 2 weekends, we gapped lower on Monday. 2 weeks ago, it was the DeepSeek release that hit over the weekend, and the market didn't have a chance to react to that. And we gapped lower on Monday. And then a week ago, it was all the tariffs. And there's probably going to be more tariffs coming out. And one thing that I do teach in the program is hedging and how you can pretty much eliminate all risk from your SPY positions. SPY is the ETF that's attached to the S&P 500. And you can also use mutual funds. There are index mutual funds, and there are ways that you can hedge those as well. It's a little more complicated, but you can do that. And so if you weren't hedged, a lot of people were freaking out. But we hit that low right after the open on Monday, and then we just kept chopping our way back. But then Friday declined, and that ended up being down for the week. President Trump did come out and announce that the U.S. will be implementing a 25% tariff on imported goods from Canada and Mexico. That's got a lot of people freaking out right now, but only 10% on imported Canadian energy. Yeah, because we get a lot of oil from Canada. And that's what the market was really unsure about. And also a 10% tariff on imported goods from China. He also indicated to the press that tariffs for the EU, hang on, Europe, we're getting to you. We're just not quite there yet. Will likely be implemented fairly soon. And this has to do with national security. It has to do with the fentanyl and the drugs and illegal immigration. And so an attempt is being, and the big culprits are especially to the south of the US. And then a lot of the drugs are coming in from China based on the research that I've seen. It goes from China over to Mexico and then across into the US. So, yeah, you might probably gonna have to pay a little bit more for your maple syrup on your pancakes. And then leaders from Canada and Mexico, they struck a deal. Imagine that. Trump is a negotiator, and he'll throw these crazy things out there like, we're going to take over Gaza. Now, is that what he's really intending to do? We don't know. He might be, he might not be, but he wants to do something there. And so he throws these ideas out, and that freaks out all the people that don't really know what's going on. But then that brings people to the table. When he was first president, he would say things about Putin. They started talking. He would say things about Kim Jong-un in North Korea. Trump went over there and visited. First U.S. president to walk across the DMZ. So now you may hate this guy with everything that's in you. That doesn't matter. You may love him. That doesn't matter either. Things are changing, and they're changing quickly. And the market's having a little bit of difficulty catching up with that. When there's doubt, the market tends to sell or at least not buy. And that's why we might be going sideways for a while. So there were deals that were reached really quickly over the weekend, last weekend, to avoid the tariffs and push them back for 1 month. Meanwhile, China said, hey, we're okay, America, you're going to do that to us, we're going to do that to you. So they put tariffs on coal and LNG, which is liquid natural gas. It's not a market I really deal with all that much. And 10% tariffs on crude oil, ag machinery, and certain cars. And that's going to start Monday, February 10th, day after the Super Bowl. China also imposed further export restrictions on key minerals such as tungsten. Yeah, and that's another reason why there's been talk about, hey, let's buy Greenland. They got a lot of stuff up there that nobody's using, and maybe we're depending on China too much just to give us some more leeway. Plus, it could be a good defense if we run into problems with Russia. So these aren't just crazy statements to make headlines. There's actually strategies behind these things. And said that it would be starting an anti-monopoly investigation against Google. I bet they're shaking. All right, the market interpreted China's retaliation as just, okay, you hit me, I'm going to hit you back. There wasn't really any teeth behind it, and a lot of name calling going back and forth. Furthermore, the tariff talk has been viewed as more of a temporary negotiating tactic than a permanent feature. And that's what I'm talking about. This is negotiating. If you don't know much about Trump's style in negotiating, read The Art of the Deal. It came out years ago. He explains how he does things like this, and he's bringing that over into his presidency. And he tried to do that in his first term. Okay, the reports that came out, some were a little bit weaker, especially on Friday, but then you look a little further back and they actually strengthened as far as the employment report. But there's also some inflationary concerns, and that has the market a little bit concerned right now. Interest rates did go down. Now, I've been really harping on this in the daily videos and on the website where we're watching that 4.5% level with the 10-year yield because we're not trending right now. So that's when I go out and I try to key off of other markets. I say, what's driving the stock market right now to make it go up or down? And it's been interest rates. Now, it's always interest rates that are in the mix. It just seems like they're a little more important right now. When we started to run into problems with the market keep going up back in December and into January, it's when we got above 4.5% with the 10-year yield. Well, we've been above that. Now we're starting to come back down, and we actually dropped below 4.5% this past week. And right about the time Mexico made their announcement and said, we're going to send 10,000 troops to the border and we're going to work with you guys, we went under 4.5%. We didn't stay there for very long, but eventually we would work our way under 4.5%. And that helped stocks to at least show some gains throughout the week. And then for the week, the dollar was down. Now, a stronger dollar, it likes tariffs. It likes all this stuff that's going on. And so the US currency tends to get stronger, but that doesn't always help the stock market because of the exchange rate and the import-export relationships. So that the dollar coming down also was more positive for stocks. Not as good, though, if you want to go on a trip. All right, earnings were released, had big, and we're still right in the middle of earnings right now. Google came out and they were down like 15%. They ended up only being down 9%. Woohoo. And then Amazon, they got smacked too, down 3.6%. And then here's a list of the other companies: Palantir, Qualcomm, Spotify, Dow. I'm sorry, Merck, a component of the Dow. Estee Lauder, maybe did you buy enough makeup? And then Pepsi. Well, I kind of prefer Coke myself, vanilla Coke to be more exact. Okay, so for the week we were down 0.5% with the Dow, and most of these losses they started on Monday, and then we were paring back those losses, and then we saw them grow again in Friday's session. We're also down about 0.5% with the Nasdaq, down 0.2% with the S&P, down 0.3% with the small caps, and they're still stuck at their either at or below their 50-day moving average on the daily charts. They're still range bound. Now the mid caps are looking a little bit better, and I don't have that here, but I'll show you a chart here in a moment. This is what we're watching, and we have been watching this for quite a while. We will continue to watch this, where we're still kind of in the downward slope of inflation. We're concerned because we might be getting ready to turn back up with inflation. And if this sticks along what we saw from 1966 to 1982, there could be some really high inflation into the future. Now, we don't know. I mean, I know there's a lot of folks that like to pair up what happened before with what's happening now, and that they use that as some kind of a prediction model. And there's some merit to that. but you're always going to deviate. History doesn't always repeat, but it does rhyme. And so there are some things that are similar. You could go and find on YouTube all these videos about how right now is compared to 1929. Well, you could take a different set of numbers and talk about how they're completely different, or how right now is different from the dot-com boom and bust in 2000. Yeah, the charts might be looking the same, but the context, depending, you can come to any conclusion that you want. And so that's why I look at charts and say, I don't forecast. I don't look out into the future. I just say, okay, this is where we're at right now. And we just want to be aware that just because inflation was going down here in the mid to late 70s doesn't mean it's always going to stay low. Things can change and inflation can go back up. All right, we're at 4.49%. We're still above the 4.02% level, which according to RenMac, when we're above that level, and we're seeing the earnings coming down a little bit. They're not as robust as they were before, and some of that can be attributed to interest rates going up. All right, this was updated, and Fred, which is the Federal Reserve site where you get a lot of charts, they updated something. So if you're used to looking at those charts, these are going to look a little bit different here. They finally made it into the 21st century, I think. But this is the number of unemployed that are long term, over 6 months here. And it's actually coming down in the latest reading where it had been going up. All right. Now, another thing that's different about this video this week is I'm recording it earlier than usual over the weekend. And the Isabel Net blog charts that I usually go through, they haven't updated yet. So this chart is from last week, and I just keep this in here as a marker. But I'll see how things go. I may be going over those Isabel Net charts in the intermarket analysis video. If you find what I talk about with the Isabel Net blog charts useful, please feel free to check out the intermarket analysis video, and I'll try to put them into that. I get the luxury of recording this a little bit earlier right now, and I wanted to take advantage of that. Okay, fact set. How are earnings looking right now? This says that the market is rewarding positive earnings per share surprises. So when they come in and they beat their estimates, more than average for the fourth quarter. So now this was Monday. So things, we had a whole week unfold after this post. To date, which means there's been 5 trading days since then, 36% of the companies in the S&P have reported for the fourth quarter. 77% are above the earnings per share that they had announced, above the mean estimate. Okay, and then they go into this gobbledygook stuff. And so in aggregate, earnings have exceeded estimates by 5%. All right, to date, the market is rewarding positive earnings surprises by S&P 500 companies more than average for the fourth quarter. All right, so you surprise to the upside, your stock goes up. But then there's other times when it goes down too. So this is just showing the surprise and then the average change in price when it's a positive report, and it gets hammered when it's a negative report. And then this looks also kind of shows this a little bit different way of how they track this. You might find that useful. And then this is looking over going out over 5 years and just showing where we're at over here on the right-hand side. That's when we have a positive surprise. And then over here, what drain is that on the stock if we have a negative surprise? Then on Friday, they updated things for the earnings season here. Now, 62% of the companies have reported, and 77 are above estimates. And now they're 7.5% above estimates, looking a little bit better. So we saw some improvement throughout the week with earnings. All right, this is what I was talking about. If you go back to Monday, we gapped lower, and everyone's the end of the world, tariffs, impeach Trump, get rid of him, he's destroying everything. Well, that lasted what, 10, 15, 20, about a half hour. All right, and then we set a bottom. This is when Mexico came out and said, yeah, okay, US of A, we might work with you guys. Just, have some nachos and just chill a little bit here. Maybe some Corona with lime or something like that. Now, we set the low right on Monday, and now we weren't going straight up here, but you can see this is pretty positive action throughout the week. And then we ended up closing right here where I have the pointer. That was the high, and that was the close for Thursday. Had we closed right there, you compare this with where we were last Friday, we would have been up on the week. Well, and then it looked like we were starting out pretty good, but then we hit that 6,100 level. That's a round number, and you've got all these computers on the exchanges that are, if we hit 6,100, sell, 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 sell. That's what started happening here. The market isn't ready to go above 6,100 right now. So that pushed things down. Well, right about the time that we hit 6,100 was when a consumer sentiment report came out. It's one of the more not huge reports, but it's still influential. And that's where it showed things being a little bit more negative than positive. And that's what they were using to justify prices going down. So then we dropped down. We tried to find some support here, tried to bounce. Neither one of those were really working. Then we ended up breaking down a little bit lower and we closed at the low for the day and well off of the highs that we had set in Thursday's session. All right. So going back over the last 5 trading days, the only index that was down was the Dow. Now, I just do the 5 trading days. This isn't Friday to Friday. This is Monday through Friday. I look at it a little bit different to get a slightly different perspective on things. But all of the indexes are positive year to date, with the NYSE doing the best right now and the NASDAQ doing the worst. But we'll see if that can change at some point. Then the different sectors, this is just the 5 trading days, and I sort it negative here according to this column when we have a down week. Discretionary, which has been the best performing sector going back to last summer, it got hit. Tesla has been under pressure. Amazon got hit after their earnings came out. Those are two big players in the discretionary sector. Let's see, what else? Real estate was up, energy. These are areas that have been getting hit hard lately. So they saw some bounce. And we were up with the tech sector, and the financial sector was up as well. We want that to be doing well also. But then over on the right-hand side, this is scored on a scale of 0 to 100. The higher the score, the better looking that sector. The financial sector is still looking good, well into the 90s. And when it's 90 or above, that's what I consider to be a really strong sector. And let's see, communication and discretionary. Those are the two big growth areas. Tech pulling back a little bit here, but it's still coming in at 69. Those are the three big growth areas that we want to do well. Communication, discretionary, and tech. When they're really firing on all cylinders, that's when the indexes really go up. And then we come down here to the bottom. We have materials and energy. These are the weaker areas right now. Okay, then looking for the week here. And again, I sort this a little bit different here, where tech and real estate and financials ended up being positive. The rest of the 11 sectors that make up the S&P 500 were negative. Year to date, we have the financials, healthcare, which is a defensive area, communication, that's a growth area, and materials driven more by the economy, and industrials, also economically driven, energy, which tends to be more defensive, and utilities, which you could almost put those into growth areas right now, especially utilities, with all these EVs and AI, and what other acronym can I throw at you? BTC, Bitcoin, and all the mining and stuff that goes on. There's going to be tremendous demand for electricity. Just how are we going to make it? And so some of these utilities companies, they might be turning into more growth companies where typically they're more defensive. This is the widows and orphans types of investments that give high dividends and are usually considered to be more safe. Where we still had staples, which is defensive, but discretionary was also down as well as tech, or is down, going back to the beginning of the year. Then looking back over the last year, though, what's the rotation like here with the different sectors, where we see that discretionary has been a stronger area and it's still strong, but it has been pulling back lately. Communication, that's another green area. And then we're seeing tech coming on a little bit here. And then these are the areas that are more weak. And as the market's been rotating through a lot of these different areas. And this shows it more in a spreadsheet type format here, where you have tech, communication, and discretionary. And these are growth areas. And this is going back over the last year. Those are the best performing areas. More neutral would be the financials, but they've been doing better lately. And then these red areas, these are ones that have been under pressure lately. And we look at the different markets here. We still have the NASDAQ 100 that's leading and the S&P 100. Those are the big stocks. The S&P 100 are the biggest stocks that make up the S&P 500, where we're still seeing a lot of drawback going into these other indexes. We are seeing some improvement here with the S&P 500, though, because the stocks in the S&P 100 and the NASDAQ 100 are also in the S&P 500. And here's what it looks like here with the S&P 100 and NASDAQ 100 doing the best longer term. Sentiment, we get a reading every week from Investors Intelligence. These are folks that have newsletters or websites and they make recommendations of things to do. Neutral right now, not extreme positive or negative. We are drifting down more and looking negative as far as sentiment here. And this shows you the chart. This is more historical. We were improving and we were going with that, but then we got up to about this 50 level, which is neutral, and now we've been pulling back. And so sentiment is turning more negative. The active asset managers, not really extreme right now. These are professional money managers. They did improve in the latest reading. Also coming in here with a slightly different look at the same reading at 84.91. The VIX, the weekly chart here, we were pretty much flat from where we were a week ago. But you can see down here the bar chart. We started out the week over 20, and then it's just been kind of coming down ever since then. Still looking good here. When we look at cash to tech, when this black line is going down, that's positive. That means tech is outperforming. And these poor folks, when you do Ridex mutual funds, which I've done them for decades and decades now, and then I switched over to doing the SPY ETF. Unfortunately, a lot of folks do this because they have jobs. They can't watch the market all the time. And they see something happening, either positive or negative, and then they react to that. And then by the time everything gets done, a move in the opposite direction ends up happening. And so, but we keep an eye on this. They're still pretty bullish overall, but this does not include Friday's session. There's a 1 day business day or 1 day lag with this chart being updated. We're coming in and getting a little bit more negative with individual investors, though. They didn't like what was happening a week or so ago, and they were turning much more negative. The Ulcer Index is still under the moving average here. That means that sentiment is not really climbing on the weekly chart. And we're still seeing not very high of a risk here when you look at the risky versus not as risky options. And this shows that same thing. This is an inverted version of the previous chart. And I didn't develop this. David Keller from stockcharts.com developed this chart, but it's to match up with what the S&P is doing. And then down here's an inverted version of the VIX as well. And when this is a really high reading, that means fear is very, very low. And it's not really getting off of that too much right now, which means there's some complacency in the bond market. Then we look at the VIX and take a 3-month average of the VIX and do a ratio. We've just been kind of meandering around lately. We're still declining with our very long-term measurement of the equity put call ratio. It still is continuing to go down. I picked 253 days here because that's the actual number of trading days. All right, then the economy. Again, these charts are going to look a little bit different. The Chicago financial conditions, we're below the black line. As long as we're below that, things are okay according to this chart. Then a couple of different charts here for the GDP now, where we're coming in between 3 and 4% that they're coming in with. Now, this is for the fourth quarter, or this is predicting 2025, the first quarter. And folks are coming in at about 2.5% to the upside and just under 2% for the downside. This next chart it's looking at the same thing here, but it's drawing it out a little bit more where they ended up having that come down under 3%. Here's another look at this. This is showing more columns in a bar chart here. And now we're focusing more on the first quarter as we're getting numbers coming out for the fourth quarter of 2024. This also is coming down. I know the perma bears just love this when we went above this red line a few months ago. And they're like, oh, it's a perfect indicator of the recession. Well, there's a person named Som who I follow on Twitter or X who said, well, I don't know if it's a real accurate reading this time. That's the person who actually developed this. But when we get up to this red line, that usually means a recession is coming. But you notice that we're starting to come back down now, where other times we go above the red line and then we tend to keep going. Well, we're falling down. We're at 0.37 now, where a zero point 0.5 reading, that's what was getting all the perma bears totally excited. And then the smooth US recession probabilities were just pretty much pegged down here towards the black line. This is not predicting a real recessionary fear. And this is a quarterly chart here with the Brave Butters Kelly leading index. It's actually coming down a little bit here. If it was continuing to go up, that would be more of a concern. Inflation now, we're going to get CPI in the upcoming week and PPI and retail sales. So these will probably adjust, but we're not seeing any real big fluctuation right now. And then 92% chance that when the Fed meets on March 19th, they're going to leave rates right where they are now. And we're pretty much locking more into that as time is going by. So then we look out at the May 7th meeting, 73.8% chance that rates are going to be the same as they are right now. And a little bit more conviction lately that that is actually what's going to happen. And then the Fed balance sheet still continues to drop off. It topped out in about June of 2022. And there was a little blip up here when we were having some of the banking situation there with Silicon Valley Bank and so forth. Then it started to resume. And this is a year over year change, which is pretty much going flat right now. These are the overnight reverse repurchase agreements. I have a hard time saying that because there's so many re's in here. We're just watching to see if this is really showing anything. Now, we're getting a very low reading right now, which you could, in a way, look at this kind of like sentiment, because this just means there's not a lot of fear. But if we see a sudden spike here, that may create some problems or at least perk up our ears to keep an ear open for what's happening. Okay, so when we look at the bigger picture here with the weekly chart of the advanced decline line, we're still positive. We're above the advancing moving average based on price and volume. And showing an expansion of the new highs on the weekly chart, also a bit of an expansion of the new lows. We're starting to turn down, but we're still above the moving average with the 4-week measure, turning down a little bit here with the 10-week measure. And we are negative with I use a 5-day and a 10-day on the daily chart. We're going down there, but we're seeing a lot more green here than red. And we're looking a little more negative here in the short term. The blue line's actually dropping below zero. The red line's still declining, but it's above zero. And this is where we're showing that we're not trending. And this is what we're seeing across all time frames right now, is the ADX is below 20. That's when we stop trending, and it's a weakening trend. We are below the moving average now, and that's still continuing to go down. And that's what we're seeing on the daily charts as well. Even though the green line's coming down, it's still above the red line. So we still would default to positive here. And the Arun indicator, which is pretty much flatlined on the daily chart, but it's still positive, it's still giving us a pretty positive reading here. This tries to measure the difference between buyers and sellers. Green are buyers, red are sellers. The mass index not getting a signal here. I'm going to be not talking about that anymore because we had a mass index trigger on the daily chart, but now like a couple of weeks have passed and nothing has really happened. So I may stop talking about that. Here's a daily chart where even though we did decline in Friday's session, we're still above the 50-day moving average. We were just barely above average with volume. And not really much to see here. There were times, if you've watched these videos for a while, where I was just harping on this in the daily video and the weekly video, I was talking about it all the time. These are pivot points, and we just had some new ones that were drawn in here at the beginning of 2025, and we're far away from them. This I really have been harping, though. This is a trend channel going back to 2009, and we're having a really hard time breaking out above the upper end of this trend channel, which may be providing overhead resistance. But we're still positive. This is a 50-week moving average. That's the red line, and price is above, and everything's going up still. And then I use a moving average crossover system here with a 13-week moving average and a 50-week moving average. And we're still above the blue line here, and both lines are going up, and price is above both of the lines. That's still positive. This is number one of our smart money indicators where we are positive here. And we're quite positive on the daily side. In fact, we were getting kind of far away from the moving average, and that came back a little bit closer in Friday's session with the decline. We're crossing down below zero with the McClellan oscillator. So that's turning things a little bit more negative there. But when we look at the summation index, we're above zero based on price. We declined, but we're still above zero based on volume. So that's still positive. And we're seeing an improvement. Even in Friday's session, there were enough point and figure buy signals to help the daily side. And we're seeing that coming up here on the weekly chart as well. This is still positive and looking good on the daily charts as well. We're declining below zero with the Swenlin trading oscillator based on price and volume. And this has been going down now for a while on the daily chart. We were starting to turn up, but now we're going back down again. So we're seeing more negativity at the current time. The Bollinger Bands, when we close above or below the upper or lower band, we're not there now. And looking at our momentum oscillators, we're rolling over with the PMO. We're still positive based on price and volume. And then there's a series of studies that go with this. This was developed by Carl Swenlin years ago, and then he expanded that to include all stocks in the S&P 500, and those are the studies that we see here. So what are the percent of stocks in the S&P 500 that have rising PMOs? That's actually declining. How about the buy signals? That's declining, and we're still going up with the PMOs that are above zero. And here's our smart money indicator number two, which is coming down. And that's a bit of a concern. Even though we're still positive, we tend to follow the direction of the red line. So that's actually turning a little more negative. And so momentum in the short term here, starting to look more negative, rolling over and still negative in the intermediate term, also still negative in the long term. We never really recuperated and switched back over to positive. We're turning more negative now. We're already kind of dropping below, even kind of flatlining with the short term on the daily side, showing some weakness in the intermediate term. We're still positive in the long term, but now finally starting to roll over. And then we look at smart money indicator number three, which is still going up and still above zero. So that's still positive there. The Chaikin oscillator, we're declining, but still above zero with the force index. We're below 50, and this is negative here, but this is not a primary indicator, in my opinion. This is actually turning negative. We're still above 50 with the RSI going back over the last 14 weeks. We're crossing below the midpoint with the Stochh RSI. We're coming down after being extreme with the Williams percent R. Ultimate oscillator still above 50, and we're still positive here with the vortex. The Copic curve, though, is negative, and we're just crossing over negative after Friday on the daily chart. So that's suggesting the momentum there is turning more negative. The rate of change, this is just from 1 week to the next week, and we were down slightly. Then going back over the last 50 weeks, this last week, and then going back 50 weeks ago, we are starting to drop a bit below the red line, but it's not necessarily falling apart right now. This is a long-term oscillator, the weekly chart of the special K. We're still above the red line. And we did fall down below this 10-week moving average here, but we were able to get back above that. So this longer-term support level is still continuing to hold. And we're still positive here, but we're looking kind of doji-ish when you have an open and a close pretty much at the same place with the Heikin Ashi chart. So that could be showing a little bit of weakness, but it hasn't switched over negative. We're positive, but pointing down with the Kegi chart. When it's black, that's positive. When it's pointing down, that's turning a little bit more negative. The Renko chart is still positive with the open blocks, and we're still positive with the three-line break. We're still above zero here with the 14-week ease of movement. And this is interesting because we had enough of an upward move in Friday's session on the daily chart. We saw a couple of new X's drawn in. Well, then we declined here, and we have a couple of O's drawn in here on the weekly chart. So that's a bit of a divergence from each other. All right, then as far as the long-term momentum, it's declining a little bit. Intermediate terms coming down a bit, and we're seeing a little bit more weakness with the short-term momentum. And we've gone from positive to neutral with the Elder's Impulse system here on the weekly chart for the S&P, and we're still positive, though, on the parabolic SAR, where we're negative on the daily side. So hasn't quite switched over yet. And just as I'm seeing this here, you might just make a note of this. You see where we set a high and then a lower high and a lower high, and we're also setting a lower low and a lower low. That's longer term. I've been trying to point this out periodically on different charts. This could rectify itself, but this is not, we just want to be aware of this, that this could be suggesting there's some weakness coming in with the lower highs and lower lows. All right, and I don't know what happened to the mid caps here. They didn't decide if they were positive or negative, but everything is looking okay here with the different stock indexes that we follow. We're positive in the short term based on bonds. Commodities are positive across the board. We're negative with the dollar in the short term. This is just no studies, no moving averages or anything of the S&P where we're kind of going sideways here. The mid caps underperforming, as are the small caps. But the Dow, even though it declined on Friday, it's still above its 13-week moving average and still in an uptrend. The Nasdaq also still looking in a solid uptrend, as is the Nasdaq 100. Small caps are in an uptrend, but they're below their 13-week moving average, which kind of loosely equates to a 50-day moving average. And we've just been chopping sideways for the most part, as have the mid caps. They've been showing some weakness, but the mid cap growth to value ratio on the daily side, it just exploded this past week to the upside. That could end up being positive. The NYSE, a broad market measure, still looking pretty solid there. This is a daily chart of the Wilshire, another broad market measure, still above the 50-day moving average. All stocks still looking good. That's US and international stocks. The FANG index, which is another like mega cap, Facebook, Apple, Amazon, Netflix, Google, still looking, and Nvidia too. And then ARC is still in an uptrend on the weekly chart. Sorry about the delay there. I had to deal with some noise. These are pretty popular videos, and I got people just screaming for my autograph all the time. And I had to go calm down the crowds here. We also keep a really close eye on the financial sector because that's what melted down during the great financial crisis. So there's a number of different things that we look at. We look at the financial sector itself. It's looking solid. We look at the bank ETF, which we were getting a little concerned there because it was showing some weakness. Well, this is a different bank index that we follow, the KWB, and a weekly chart here where it's coming down a little bit, but we're looking good on a momentum basis with the RSI, and we're trying to turn back positive here with the MACD. Then looking at the seasonality chart going from 2025, including this year back to 2021. That's as far back as I can go with this chart. I get this from stockcharts.com. So we're looking at February where we're up about 40% of the time. February is not a great month seasonally, even in most years. I don't know. Valentine's Day and the Super Bowl. I guess that takes everybody's optimism and doesn't shift it over to the stock market. Okay, then looking at the broad market here, this is traditional Dow theory, which is just the Dow and the transports, which are underperforming. You can see that. And then I also include utilities here, which have lately been underperforming after they were quite strong earlier in 2024. We look at the weekly chart here, commodities, and these are going up, and that's causing some inflationary concerns. Oil's actually coming down, though. We're hitting the lower end of the 70 range. The dollar is still in an uptrend, which may be causing some pressure on the markets. Copper on the weekly side is in an uptrend. On the daily side, it doesn't know what it wants to do. It's actually in a downtrend there. Gold is coming off of an all-time high here with the gold ETF. Silver, not at an all-time high, but still in an uptrend and showing some improvement. And then we keep an eye on the price of bonds, the total bond ETF. We have been able to bounce back up above this red line, which is a 50-week moving average. And this is showing a little bit of an improvement here. And we came down with the stock to bond ratio, the monthly chart, a little bit here, but we're still showing how stocks are outperforming. This is a daily chart of yields where we have been declining. That helps stocks when we're going back up. That tends to pressure stocks. And we're keeping an eye on this. And I've been talking about this in the daily video and lots of different videos because this red line here, that's the 10-year yield in Japan. And if that keeps going up, remember what happened last summer with the end of the world day and the VIX shot up to 65 and everybody's freaking out. And that lasted what, a couple of days there? Well, when we went up over 1% with the 10-year yield, that's kind of what triggered this whole thing. Well, we're continuing to go up, and the Bank of Japan did raise their rates week before last. And so is that going to cause a problem? that's without going into a lot of detail. We just want to watch this. If it keeps going up, then if we start seeing those rumblings again, then I'll explain it a little more in detail. And we look at some relative studies. This is going back to the beginning of the year, where we have gold looking the best, followed by, let's see, stocks are in second place now. That's the black line. The blue line are bonds based on price, and then oil is the red line, and then the green line is the dollar. Everything's positive year to date, but we got a lot of year left to go. Then we look at a ratio between the NASDAQ 100 and the S&P, falling back a little bit, but still showing how the NASDAQ 100 is outperforming. The S&P 100 falling back when compared to the S&P 500, but still outperforming. Growth is still outperforming value. That's what we want in a good positive environment. You notice how this ratio went down in 2022 when we were in a cyclical bear market? Well, we're still in a cyclical bull market here. And gold to the S&P, not really moving all that much now. Gold to the dollar, gold has been outperforming the dollar. Bonds have been underperforming stocks longer term. And we're still seeing this ratio going down with low volatility stocks compared to the S&P longer term. And this also showing how discretionary is outperforming staples. And that's what we want to see in a more positive environment. Going back to 2022, you see how this was really going down. Now we're still really going up. Energy to tech ratio, how energy is underperforming tech longer term. Small caps continue to underperform the tech sector longer term. And then here's some different charts, not really getting much here from the NYSE breadth thrust chart. This is the swag NYSE breadth thrust, not getting a recent signal now. And the signals that we did get weren't within the window of when they should have been triggered. Long term, going back to the 1987 crash, we're still looking good with the weekly chart of the S&P. We're still on a full-on buy signal with the Zohorchak method. That hasn't changed. And we look at the NASDAQ 100 weekly chart going back to 2009, still solid with its uptrend there. Then we look at a 50-week moving average of the new highs minus the new lows on the NYSE. This is still going up. And so that's showing some improvement. We're also showing some improvement here when we do that same thing, but look at the S&P 500 50-period exponential moving average of the new highs minus the new lows. Then we look at a ratio between the NASDAQ 100 and the Dow. We're still above this red line. The Qs, the NASDAQ 100 to small caps, still above this blue line. And we're keeping an eye on the 3-month yield. We want to see, is something going to happen like we saw back in late 2007 into 2008? Not seeing that yet. And then that led into the great financial crisis. And this is showing a little bit of recent weakness here. This is a cumulative new highs and new lows on the NASDAQ. It's been improving, but now it's starting to turn down slightly. But the NASDAQ has been one of the better performing indexes now for the last year to 2 years. Seasonality, looking at February, average return of 0. We're only up 53% of the time. So it's almost a coin toss there. But November to April is the best time. And that's up 7.1%, 77% of the time it's higher. And we're still in the first half of February, which is no gangbuster performing time, but it's better than when we get into the second half of February. And then the first quarter after a presidential cycle, it's nothing great right there. And this looks at the whole year and with the latest reading here, right near the end of January. And however you want to look at this, whether it's all election years, post-election years, that's the black line. And then the 5th year of the presidency, which really that is, even though it was separated by 4 years. And then the incumbent party wins. Well, that didn't happen, so we don't really want to follow the green line. The incumbent party loses, that's the red line. And that might be a little more negative because that means, uh-oh, they didn't like what's happening there. And then we look at the aggregate, which is everything taken together going out for the rest of the year. Okay, I've been showing this in the daily video too, the first half of February versus the second half of February. And then we're 50-50 when we look at the S&P going back to 1950 and post-election years with a return of minus 1.3%. So thank you. I hope you found this helpful. Have a really good weekend. Enjoy the Super Bowl if you're getting a chance to watch this before. If you're watching this after the Super Bowl, I hope your team won, and I will talk to you in the next video.